which leads us into there's a whole bunch of markets out there that look expensive. So we've obviously seen, we're now in a situation. I wrote a paper which I think the guys are going to release out to the network, where I think in 2013 or 14 I wrote a paper and I said that the 4 or 5 top stocks in the US were larger than the top 200 stocks in Australia. I just updated those charts. Apple is now larger than the whole ASX 200, and it's considerably larger. And even this correction, it will still be larger. So we've seen a whole race up in, let's call them FANGs, but there are other expensive markets out there. Certainly government bonds, no yield, 10 years, 30-year paper, who cares? Expensive, and growth stocks. And there's talk about rotation, but we haven't seen much rotation yet towards vote. What are your thoughts?
Yeah, lots there to pack. So I'm going to break it down. In our eyes, what's fully priced and or expensive, and in some case bordering on a bubble? Long-term government bonds around the world, don't really want to own them. Highly glamorous stocks that have gone up a lot since March, that are either losing money but have put on multiple $1 billion in market cap, or the promise of making money. So when Tesla has a PE ratio of 1200 and after the 20% fall, it's a 900 PE ratio, as far as I'm concerned, Tesla can fall another 60% and would still be an expensive car stock. Whether you're an afterpay that goes, I don't know, from $9 to 90, it's back to $75. Again, you being an ex-banker, that's unsecured short-term credit financing. Okay, it's done well in JobKeeper, JobSeeker. The world will normalise as the baton passes from the government sector to the private sector. Let's just see how their accounts receivables go.
Yeah,
and I'd be interesting in debtors in days going up.
Yeah, the problem with guys like Afterpay is they're doing really well. But sooner or later, the big guys will check into the game, and it's like taking an M1 Abrams battle tank with a Shanghai. You're going to come second badly. Now, maybe you can sell your business out and what have you, or you can find a big international partner, and good luck to them. But never underestimate the capacity of a large Australian bank to completely screw your economic well-being.
Yeah, so I think these glamorous stocks have gone through the roof. Interesting, you said, the five top stocks on the S&P, which is, your Microsoft, Facebook, Google, Apple, Amazon.
Yeah, you got
it. They've gone up 3 or 4 times since 2013, 14, maybe higher. The rest of the 495 stocks have been flat.
Correct.
And so the S&P has been driven by, there's no breadth, as the old timers would say, in the equity market. Okay, well, one value strategy is to not own the top 5. The top 5 don't own any today and hold 495 stocks in the US that haven't gone up. That's the rest of the S&P 500 market. Now that's a deep value strategy, but I'm pretty broad. That's where the opportunities are in value or valuation. In other words, finding the companies that have okay balance sheets, still have businesses that have not participated in this miraculous comeback, Lazarus-like, since March. And you'll find that there are a lot around the world that have been left behind, and that's where the interest is, right? And, when Warren Buffett's buying in Japan, or looking at that, he's signaling as a valuation or value manager that he can't get excited. Now, he owns Apple, right? But that game is played. What is Apple, by the way? That's the world's most expensive margins on mobile phones. Okay, it's got streaming devices, it's got iTunes, and it's got all the other stuff that it's picking up. But like you said, in a capitalist economy, things come in to reduce profit margins. That's good capitalism, right? You get no inflation. So, these things will happen unless things become very localized. Tech stocks are expensive. The rest that's where the interest is. But you have to be patient and you have to be medium term. You have to think beyond 4 or 5 years. And some of the managers that you'll like, that you will push into the network. So I like them. They're value evaluation managers, and rightly so. Some of the folks will look at and go, but they haven't done anything in the last 4 or 5 years. Exactly. If you haven't had FANG or tech, you've done nothing. You actually want to hold your nose and buy this stuff now because it's kind of interesting.
Yeah, I think, I mean, your point around Apple was correct. I mean, Buffett himself said, you know, Warren, they said, Warren, you don't like technology stocks and you typically, you know, done poorly out of them. So why have you bought Apple? And he said, oh, well, it's not a technology stock, it's a marketing company. And he's probably right. Yes. And you know, you once again, I find, you know, where we're looking, where we're talking, because we're underweight equities, because we took the view out of March, even though you got that significant rebound, is the information that you could make decisions on was non-existent. I think the word around here was piffle. So we stayed out. You know, our job in a lot of ways is to protect people's income, because it's taken them a long time to earn those nest eggs, and it's very easy to blow them up. So we were abundance of caution. Now, as you start looking at it and you start to break down those indices, you see these big tech companies have gone really well, and you see nothing sort of below that, and that's unusual. We've seen it. We saw it before coming into the 2000s. I did note, as a matter of interest, last night that I think it's the S&P. The S&P board knocked back the inclusion of Tesla.
Yep.
And what they were saying is, well, you might be excited about Tesla, but then again, back in 2000, we were excited about Yahoo, and the minute we put them in, they collapsed. So, yeah, I think there is value out there, and then the trick is to execute it, and the patience, because value managers haven't performed for so long
10
that
years.
we can hardly remember when they did perform.
Yeah.